Hello and welcome to our second lesson on financial instruments, and in this lesson we'll be looking at compound financial instruments. Now, compound financial instruments are instruments which have both a liability component and an equity component. So it is a single financial instrument that will have both a liability component and an equity component. Typically, it arises when an entity issues convertible debt. Convertible debt, an example, is a bond that can be converted into ordinary shares of the issuer. Fine. An example of a compound financial instrument is when a company issues a convertible bond worth 10 million shillings. The bondholder will receive interest, and the bondholder will also have the option to convert that bond into equity shares on maturity. Why are we saying this is a compound financial instrument? It is a compound financial instrument because it has two components. The first component being the liability component, and it is giving the holder, the issuer, not the holder, the issuer, the obligation to pay interest and principal in cash. And it is an equity component because the holder has the option to convert it into a fixed number of shares. Good. Now, how do we treat this? As with reference to IAS 36 or IAS 32 of financial instruments. So we have said that this compound financial instrument will have two components: the equity component and the liability component. So the first step as indicated here is to identify the components. We identify both the financial liability or the liability component and the equity component. From there, we go ahead and split. We split the liability component and the equity component into two components. So, from there, let us look at the measurement. So, the first step when measuring this compound financial instrument is to measure the liability component first. As indicated here, we measure the liability component first at the present value of the future cash flows, and we will use a market interest rate for a similar debt without conversion. So we will compute the present value of future cash flows. We'll compute the present value of future cash flow. This is where we take the cash flow multiplied by the present value interest factor, and this will give us the present value of future cash flows. From there, we will go to step 2, where we will take the total proceeds from these cash flows minus the liability component, and that will give us the equity component. So there is no subsequent remeasurement that is required. To illustrate this, I want us to do a question on May 2021, question 4. The question reads that Naivasha Limited issued 500 convertible loan notes on 1st January 2018 at par. Each loan note is convertible in 3 years time at its par value of 2,000 shillings per note. Alternatively, each note can be converted at maturity date, which is on 1st January 2021, into 125 10 ordinary shares. 125 shillings, 10 ordinary shares. The loan notes pay interest annually in arrears at a coupon interest rate based on the nominal value of 6%. The prevailing market interest rate for the 3-year loan note without conversion rights is 9%. You are required to prepare the extracts or a financial statement for Naivasha Limited for each of the years ending 31st December 2018, 2019 and 2020. Good. So the first thing is to identify the two components. In this case, we have a liability and an equity component, because they have these loan notes, and these loan notes are convertible into 10 ordinary shares. After that, we go ahead and do the measurement, and we will start by measuring the liability component. And the liability component will take the cash flows multiplied by the present value interest factor, so that we can get the present value of those cash flows. Let's go ahead and do that. So we have the financial assets at amortized cost. Pardon, the financial liability, not financial assets. So we prepare the amortized cost. Now we have, let's go ahead and let's go back and look at the question again. We have 500 convertible loan notes, and each loan note is valued at 2,000 shillings. So 500 loan notes, each loan note at 2,000 shillings. Now the cash flows from this loan note are 6%. So we have 6%. So the cash flows in this case will be 6% multiplied by 500 times 2,000. So this will give us 500 times 2,000 is 1 million. So 1 million times 6% is 60,000. 60,000. So that will be our cash flow. So let's go ahead and prepare the schedule. So we'll have let's prepare a table. We have the year, we have the cash flow, we have the discounting factor, we also have the present value. We'll start with 2018. 2018, we have the cash flow is 60,000, and the discounting factor is at 9%. So we'll take 1 plus r power negative n, so it will be 1.09 power negative 1, which is giving me 0.9174. So multiply 60,000 times 0.9174. This is 55,044. Go to 2019. 2019 we have 60,000. 60,000, 1 plus r power negative 2 is giving me 0.8417. Multiply this and this, 60,000 times 0.8417. This is giving me 50,502. We go ahead and look at the second year, 2020. 60,000, the cash flow 0.772. That is the cash flow for year 3. That is the discounting factor for year 3. Now, the cash flow for year 3 on 2020 will include the interest at 6%, and also remember this financial instrument is, or these loan notes are redeemable in 3 years, so they are going to be redeemed in 3 years time. These loan notes are going to be redeemed in 3 years time. So in 3 years time is when we'll now give back the 1 million. So the cash flow or receive the 1 million. So the cash flow will be 60,000 plus the 1 million, yeah? Plus the 1 million is when now we will get back the 1 million. Now when we'll get back the 1 million. So in year 3, we are going to receive 60, which is the interest we are calling the cash flow, plus the 1 million. So we have a total of 1,060,000 multiplied by 0.7722, and that will give me 800,000, 18,532. I can go ahead and add all the three, and that is giving me 924,078. Now this is now what we are referring to as the liability component. That is now what we are referring to as the liability component. Good. Let us now look at the steps for splitting the liability and the equity component. So we said to split, we will take the equity component is given by the total proceeds. In this case, the total proceeds are 1 million. The total proceeds are 1 million. So the total proceeds are 1 million, which is 500 times 2,000. Those are the total proceeds, minus the liability component, which is 924,078. That will give us the equity component. So we can come here and say the equity component is given by 1 million minus 924,078. This is giving me 1 million minus 924,078 is 75,922. That is the liability. That is the equity component. That is the equity component. Now, how do we value the liability component? Remember, going back on our previous lesson, we said that liability component or a financial liability is measured at amortized cost. A financial liability is measured at amortized cost. So what we are going to do, we are going to prepare an amortization schedule. We are going to prepare an amortization schedule for the liability component. We are going to prepare an amortization schedule for the liability component. So the liability component, so determination of amortized cost, determination of amortized cost, determination of amortized cost. Now the determination of amortized cost is given by, you take the year, prepare an amortization schedule, the balance brought down, the finance cost, the cash paid, and finally we have the balance carried down. So we have 2018. So in 2018, the balance will take the liability component, which is 924,078. 924,078. Remember, the finance cost, we are going to take the 9%. The 9%, which is the prevailing market rate. The 9%. So at 9%. So 9% of 924,078, that is giving me 83,167. 83,167. And the cash paid, remember, each year we are paying 60,000. Each year we are paying 60,000. And the balance will now be 924,078 plus 83,167 minus 60,000, which is giving us 947,245. We have 2019. In 2019, we take the balance carried down from 2018 and bring it as the balance brought down for 2019, which is 947,245. The finance cost will be 9% of 947,245, which is giving me 85,252. 85,252. The cash paid again is 60,000, and then the balance carried down will be 947,245 plus 85,252 minus 60,000, which is 972,497. Finally, we have the year 2020. We have the year 2020. So when the bond is being redeemed, so we have 972, the loan note, 972,497, and 9% of that one is 87,525. 87,525. The cash paid is 60,000, and since it's being redeemed in 2020, so it will be 60,000 plus now the 1 million. We are going to pay back the 1 million. So 60 plus 1 million is 1060, and we'll have nothing left. So that is the amortized cost of the bond. We can now go ahead and prepare the extract. With that, now we can go ahead and prepare the extract. So P&L extract, P&L extract. So we have the year and the finance cost. We have the year and the finance cost. So 2018, the finance cost was 83,167. 83,167. In 2019, the finance cost was 85,252. 85,252. And then lastly, in 2020, the finance cost was 87,525. 2020, 87,525. On my next page, let me go ahead and prepare the balance sheet extract. The balance extract. The balance sheet extract. So for the balance sheet extract, we have the non-current liabilities and the current liabilities, and also the equity section, because it was a compound financial instrument with both the liability component and the equity component. So we have non-current liabilities, non-current liabilities, non-current liabilities. So non-current liability we have in 2018, 2019 and 2020. 2018, 2019 and 2020. So in non-current liability we have the 6% convertible loan note, 6% convertible loan notes. For the non-current liability, we only have one, which is the first year, which is right here, 947,245, which is payable in 2020. 947,245. In the current liability, we have the 6% convertible loan notes. So we have none here, and 972, 497, 972, 497, and none there. Lastly, we have equity. Equity. For equity, we have the equity option. The equity option is given by, let's see, let's go ahead and find it out on our calculation. The equity component was valued at 75,992. So that 75,992 will be on our balance sheet as a reserve up to the date the holder will exercise the option to convert into ordinary shares. So we have in 2018 75,992, 992, 75, 992 and 75, 992, and that marks the end of our illustration. And in the next session we will go ahead and look at another illustration.